Halyard Capital managed $4 billion. They lost it all because a spreadsheet rounded to the nearest cent, 0.3%. That's the margin that separated genius from bankruptcy. This is the story of how nobody noticed. Halyard wasn't reckless. That's the part everyone gets wrong. Founded in 2011 by a former Goldman quant named Eric Voss, the fund built its entire identity on precision. Voss didn't gamble, he modeled. By 2019, Halyard's flagship strategy, a high-frequency arbitrage system nicknamed the Ledger, was executing 40,000 trades a day, small trades, fractions of a cent per share. Multiplied by volume, so massive it barely looked like trading anymore. It looked like breathing. The system worked because of one core assumption. Every trade calculation ran through a pricing engine built in 2013. The engine rounded fractional prices to 4 decimal places. That was the industry standard. Nobody questioned it. For 6 years, that assumption held. Then, in early 2019, the exchange Halyard upgraded its own pricing feed, 6 decimal places instead of 4. A technical improvement, barely a footnote in the exchange's release notes. Halyard's engine didn't upgrade with it. It kept rounding to 4. The system didn't break. That's the horrifying part. It kept running, just very slightly wrong. But the real question isn't how the rounding happened, it's who was supposed to catch it. Halyard had a risk team, 12 people. Their job was reconciliation, making sure the model's predicted P&L matched the actual P&L at the end of each day. For months, there was a gap, a small one, under half a basis point, most days. The risk team had a name for gaps that size. They called it noise. Noise is a dangerous word in finance. It means we've decided not to look at this. Internal Slack messages later surfaced in the fund's wind-down filings. One risk analyst wrote, in October 2019, reconciliation gap persisting, rounding artifact, probably, low priority, on a fund running $4 billion through a system trading 40,000 times a day. What nobody at Halyard understood was that the gap wasn't static. It was compounding, because the ledger didn't just execute trades, it fed its own outputs back into its next pricing decision. A tiny rounding error in trade 1 became a slightly larger input error in trade 2. By trade 40,000, the drift had a shape. It was making the same directional mistake over and over at scale. By January 2020, the fund's actual returns had quietly diverged from its modeled returns by 4% annualized. 4% doesn't sound like collapse. On a leveraged high-frequency book, 4% is a crater. Voss found out the way most founders find out something's wrong, a margin call from the prime broker. He had 11 hours before the exchange closed his positions automatically. The unwind took 4 days. Halyard sold $3.8 billion in positions into a market that knew exactly what was happening, because everyone could see the same forced liquidation pattern hitting the tape. Other funds shorted against Halyard's own unwind. They made money off Halyard's mistake in real time. By the 4th day, Halyard was worth $340 million, down from $4 billion, a 92% loss. But here's what the Wendown report never made headlines. The SEC's post-mortem didn't blame the algorithm. It blamed the meeting that didn't happen. In September 2019, 4 months before the collapse, a junior engineer flagged the exchange's decimal upgrade in a routine internal memo. He recommended a full pricing engine audit. The memo was never escalated past his direct manager. That manager left Halyard in November, 2 months before the collapse, for an unrelated job at a competitor. The memo left with nobody reading it. 0.1%, sitting in an inbox, not in a spreadsheet. Halyard Capital doesn't exist anymore. Eric Voss runs a 3-person advisory shop now. The real question isn't whether a rounding error can sink a fund, it's how many funds right now have the same memo sitting in the same unread inbox.